What's up, guys? Back with another video today, and I will be getting into investments today once again, but this time I'm going over classification slash types of equity securities. So you may be wondering, well, if I'm an investor, where do I start? So you might go on websites or forums and say, I need to start here or there. Let me listen to somebody. But when you listen to people, you may not get the expected result that you want. See, some people may have good things happen to them, a good ROI on a stock. But the thing is, you cannot take everybody's advice seriously because sure, some people may have got their ROI, but that's because they did things back then. You're looking for now, and it may not be the same result as back then to now than is now to the future. So what you need to do is your due diligence, or DD, as we say in the financial industry. Do your research, get that knowledge, get the understanding of a stock. Because once you have understanding, you'll say, well, maybe the stock is for my portfolio, or maybe it's not. Maybe you want to short it, maybe you want to do a call on it. I can get into that stuff at another episode, but right now we're keeping it slow, we're keeping it steady, we're keeping it good. So, types of equity security classifications, I'm getting it straight from my book again that I got for my Series 7 top off. And we're going to start off with blue chip stocks. So, you probably say, okay, what is a blue chip stock? It's a stock issued by a company that is generally nationally known with a reputation for quality management, products, and services. So, they're basically a really, really great company. And maybe a blue chip stock would probably be around Amazon, nationally known, quality management, good products, good service, blue chip stock. So people invest in blue chip stocks because they're more stable than your average stock. So let's say you're investing in a regular company, just a regular company that's not really nationally known, but they're well known enough. Let's say that. So because they're not a top giant, maybe they're more susceptible to being volatile. But a blue chip stock, all else equal, in a decent market, not saying a market like right now where things may be fluctuating a little bit, maybe going down a little bit, or not as bad as 2020 or 2021 when we had high volatility. Let's just say in the average market where there may be some days decline a little bit, but mostly maybe days of more positives than declines. And a blue chip stock, it says it's able to pay moderate dividends consistently in good times and bad times. So a blue chip stock will give you dividends good times and bad times. For those of you that don't know what a dividend is, it's a payout or ratio percentage of the earnings a company has after net income that they want to give back to shareholders. Now, a company could either reinvest the retained earnings or they can have it come out as dividends. So, if they give out a dividend, remember, as a common stockholder, you are not entitled to dividends. So if you buy a stock and say, well, where's my dividend? Where's my quarterly dividend? Where's my annually dividend? That's not entitled to you as a common stockholder. You are not entitled to any type of dividend as a common stockholder. Remember that. So the blue chip stock, it says the companies maintain a 50% dividend payout ratio, which means they pay out half of their net profits as dividends. So yeah, that can be good, but maybe the stock might cost a little bit more than, like I said, that well-known company, but not nationally well-known. So a blue chip stock, it's good for you if you have enough money to want to get it. You could fractionally invest in there. But the main thing is they have good quality management, products, and services. So they're well known. They're probably a big giant in their industry, and they're able to help you be stable and a little bit consistent. Let's put it like that. A growth stock. A growth stock is issued by a company that is expected to have above average increase in revenues and earnings. So the book says that this company right here has high percentage of retained earnings, so they pay little or no dividends. So now, like I said, you're not entitled as a common stockholder to those dividends. They pay little or no dividends. And they have a high PE ratio, so price to earnings. And they're an emerging growth company, fast growing. So say a company that just started in about 6 months, and about 4 months later, they already shot up in market value. So it says a total annual gross revenues of less than 1.7 billion, previously 1.0 billion, during its most completed fiscal year. So here's the thing about these guys, growth stock. You invest in these stocks to make sure you get quick returns. Just like that, like bam, quick returns. Now, define quick, obviously a year or less, but it says it's generally characterized by high risk, high return, high failure rates. So say you invest in a company that's really fast growing, you say, man, this is a lot of money they're generating. I need to go and catch this stock before it takes off and I won't have enough to invest. Okay, that growth stock, once it's labeled as a growth stock and you see all the parameters of it, high risk. Now, obviously, when we're going to the market, we're accepting the risk that we may lose all, some, or gain some money. The thing is with the growth stock is you're taking a high risk for a high reward. High risk, high return. That's what it's characterized as. But once you invest in a growth stock, you will have to pay the taxes regardless on whatever you sell from it. So even though it may be a lot of money coming back to you, just remember you have short-term capital gains, long-term capital gains. For a growth stock, maybe some people are there mostly for the short term and say, I don't want long term, I'm just here for the fast money. So remember, it's high risk, high return, but also high failure rates. So you're taking the risk once you enter the market. No point in trying to bring up a lawsuit. You're taking that high risk on a high return, but high failure. That's a growth stock. A cyclical stock. Stock that's heavily affected by normal business economic cycles. So it says they rise and decline with the rise in the economy and the fall of the economy. So examples are auto manufacturers, steel companies, housing companies, tool and die manufacturers. So let's say you just invest in auto manufacturers. You invest in BMW. And you're like, oh man, the market's going down. So then BMW goes down. Or you're going to invest in something like Ford. Okay, market's going down. Ford's going down. So basically they rise and fall, cyclical stocks, they rise and fall with the economy. So if you want to invest in things that are United States and it goes up and down with the market trends of the economy, then hey, it's all for you. So just remember, do your due diligence, do your research, do your historical reports and see what is the average return per year on this stock. So that's a cyclical stock. Counter-cyclical. So if cyclical is affected by the normal business and economic cycles, counter-cyclical, opposite. They move in the opposite direction of the economy. So examples would be budget retailers, Walmart, gold mining companies. So let's say the counter-cyclical stock is like, man, economy is going down, but you can invest in gold mining companies, and they might just be going up. Counter-cyclical. So if the economy is going down, put your money in gold mining company, might be going up. I'm not telling you what to do. I'm just telling you an example. So that's how you make your due diligence. Okay, so we have non-cyclical defensive, not defense industry, defensive. A defensive stock is a stock that is resistant to normal business cycle and general stock fluctuations. So you're probably saying, okay, give me something in simple terms. The simple term is that the investor would not expect significant increases or growth in defensive stocks. Stable and consistent earnings year after year. So if you want something that's stable, something that's consistent for you, that you won't have to really worry about, invest in tobacco companies, utility companies, food, pharmaceuticals, auto repair companies. Not auto manufacturers, auto repair. See, auto manufacturers are for cyclical. Move up and down with the business. Move up and down with the markets and the economy. Defensive stocks, defensive, not defense, guys, defensive. Defensive stocks give you stable and consistent returns year after year. So tobacco, utilities, food, pharmaceuticals, invest in those if you want a defense stock. It does not include steel companies, auto manufacturers, tool and die, because those are cyclical. Those move and fluctuate up and down with the economy. So I just gave you guys some information on the stocks, and you can do whatever you want. Take it or leave it. But I just told you what certain stocks are which, and it's your choice to make your due diligence and to go after which one seems best for your portfolio. So if you want something that's going to just give you stability, defense. If you want something that you can track with the fluctuations of the economy, you got cyclical. If the economy is in a bad time, you're like, man, I don't have nothing to invest in, counter-cyclical. If you want something that's well-known that could give you some good dividends, you got a blue chip stock. Well-known company. So, if they're going good, you're going good too. Or if you want something that's fast growing and you want to catch a short-term capital gain, got a growth stock. So you do what you want. But I just gave you the blueprint. It's up to you to make it. This is not financial advice. This is information. So thanks guys for watching, tuning in. I will get to you guys for the next video.